All right. Good afternoon, everyone. Nice to see you again. And today I'm going to present my job market paper on corporate venture capital and startup outcomes.
Wait, Daisy, I have a question. Where are you going now that you have a job?
Oh, that I'm very glad you asked. Just well, I'm actually gonna become a colleague of Danny pretty soon in the fall. I'll be going to the finance department at USC.
Oh, cool.
So let me start. I know like you guys are in this merger and acquisition slash tech VC field for a long time, so I'll be very brief about this part, introduction part. So the topic of today's paper is on corporate venture capital, and what are they? They are venture capital funds that are fully corporation sponsored. And like other VCs, they make those minority investment in the startup equity financing rounds. And CVC has been growing pretty rapidly in the past 20 years. So as of 2021, at least 20% of all startup equity financing rounds has at least one CVC investor. So here is the list of companies that have a CVC unit, and the actual number of firms exceeds this list. So on this list, you see traditional tech companies like Google, Microsoft, Cisco, pharmaceutical companies like Johnson & Johnson. But you also see companies from more traditional industries like GM and GE. Actually, these phenomena of CVC is very prevalent. So as of 2022, I think 71% of all Fortune 100 companies has a CVC with it. Now, one way to think about CVC is that they are a small subset of VC. But today I want to give you a different perspective, which is especially relevant for today's topic, which is to think about this CVC in the context of strategic interactions between the incumbent firm and the startup. There are many ways these two types of firms interact. On the one hand, they collaborate through knowledge spillover, patent licensing and trading and strategic alliances. But on the other hand, they are also potential competitors in the product market. And therefore, recently, we're starting to see phenomena like kill acquisition or kill zones coming up. And what CVC does in this framework is a unique financing channel that allows the incumbent firm to interact with a wide range of startups before making a full-blown majority acquisition for some of them. But then in exchange for this investment, they get access to the technologies and what is going on inside the company. So let me give you two examples to help you think about the kind of investment philosophy of the CVC. So the first one is where they're using those CVCs to foster the strategic synergies between the incumbent firm and the startup. One example of that is Google's CVC investment in Uber. This is done in 2023. So before 2023, Uber already reached a certain scale. They've secured Series A financing, but they are still relatively young. And as they scale up, they are starting to struggle with fraud planning. And this is where Google's investment becomes very handy because they brought to the table not only the funding, but also this map service that Google is an expert in. That helps Uber a lot in helping to plan for the route and helping to match the customers with the drivers. Another type of deal that CVC usually do is one type of deal that help them diversify, help them learn about new industries and technologies they're not currently in. One example of that is Pfizer's investment in this neuroscience industry. So Pfizer has many lines within the pharmaceutical space, but they're relatively new to this neuroscience industry. And they have some internal R&D resources, but they wanted to use them in more readily marketable products. But at the same time, they also don't want to miss out on these opportunities to interact with external R&D resources produced by those external startups. So that's why they use the CVCs to make a lot of investment in that space. And this Neuronetics is one of them. And it's actually one of the most successful ones they made, and that led to the IPO in 2018. So hopefully from these two examples, you would have an idea why CVC is not just another VC, because traditional VC has known to be a profit maximizing business. So 100% of their payoff is through the value of the portfolio companies that they invest in. Whereas for CVC, it's a very completely different game. They have the value coming from those startups that they invest in, but they're also having this huge asset in place from their parent company. So they're actually weighting this trade-offs of benefiting from the startups, and at the same time helping this parent company in terms of serving the strategic objectives. So those could include both fostering synergies, as we saw in the Google Uber case, learning experimentation, as we saw in the Pfizer case, but it could also be potentially used as a device to deter competition and push entry. So my paper looked at how these different motivations of doing CVC deals would affect the startup outcome. So the answer to this question is not exactly clear, because on the positive side, they are the ones that provide fundings for the startup, and they're also bring to the table a lot of those unique resources and support that traditional VCs might not be able to substitute, because we have the ground knowledge of running the business. If this is the case, you would actually expect the startups to be better off in terms of having a higher likelihood of IPO, lower likelihood of failure, and also improving their innovation output. But on the other hand, if you think this anti-competitive effect is really playing a role, this would mean that the startup receiving those CVC investment might actually face a limited growth option. This would manifest in terms of increasing failure rate, lowering likelihood of IPO, and also reducing our innovations, especially those that are directly affecting the CVC parent company's product market. But of course, normally the CVC is only one minority investment in the company. The entrepreneurs, they have the majority control. There are other investors on this deal. So the actual ability for the CVC to really induce this kind of conflict of interest depends critically on how much control they have over the company.
Can I ask a question there? It's a basic assumption question. Unlike a traditional IO type paper, here you're introducing governance features. And so I'll ask, what about fiduciary duties? If the CVC is on the board, the kind of second set of questions you have come into real tension with fiduciary duties.
I'm very glad you asked this question, because a lot of times what you see the CVC does is they don't normally take board seats, particular for that reason. They normally take what they call board observer seats that allow them to sit in all the board rooms, but they don't have the right voting power. So associated with that, they are not liable for this fiduciary duties of acting in the best interest of the startup. That would give them a lot more freedom to kind of communicate this information they get out of the company. All right, so in this morning, I think the panelists were talking about, how do we quantify this potential impact of a particular deal, especially we have to think carefully what the counterfactual is. This is actually an empirical question, which I hope I can help understand better in this paper. So you can think about this endogeneity concern as you have to differentiate the selection from the treatment. The selection, this is kind of a academic jargon. What this means is those those CVCs or VCs in general, they're not like randomly picking a startup to invest. So those companies that got the CVC investment might be very different to begin with from other firms. And on top of that, we have the treatment effect, which is them causally making the startups better off or worse off. So we wanted to see the treatment effects, but we also have to carefully consider the selection effects. Because if you just cross-sectionally compare those CVC invested versus non-CVC invested startups, you don't know how much of that is actually contributing to this ex-ante difference in the fundamentals. So the identification strategy that I'm using in this paper is an instrumental variable approach that takes advantage of the institutional feature of the CVC, that they directly draw money from the parent company's balance sheet. Therefore, we can think about a case where in certain years, Google is doing extremely well, and therefore they have a lot of cash on the balance sheet. They're able to fund their CVC investment, and therefore the startups are more likely to have a CVC investment. Whereas in certain years, we have a negative cash flow shock, then the CVC's investment will be limited. All right, so this is the IV. I will talk about the more in-board details in a minute. But using this IV, what I find is that on average, the CVC seems to have a positive impact on the startup. I find that on average, receiving CVC investment reduces the likelihood of failure, increasing the startup likelihood of IPO. I also find a higher likelihood of this startup eventually being acquired by CVC parent company, but those are only 3% of the total acquisition exit. So most of the firms actually are not sold to the CVC parent company. in terms of the actual competitive effects, actually you still find some of the results in that round, especially when in the cases where CVC has more controls over the startups. I look into two cases where this is more likely to be true. The first one is CVC investing in early stage startups, and the second one is when CVC investing as dominant market investor. In terms of the innovation result, I actually find that the CVC reduces the most disruptive type of startup innovations that are directly related to the CVC's product market. So this could be an evidence of them trying to push their startups outside of their core business in order to deter entry. All right, so for the sake of time, I'm going to skip the literature review and give you more satellite fact about CVC investment. So one prominent feature of the CVC is that we've been growing pretty rapidly in the past 10 years. So this is a graph of all the startup equity financing in the past weighted by value. So you can see that those in red are CVC sponsored deals, and they're not growing in not only in absolute terms, but also in relative importance in this whole venture investing space. Another prominent feature of CVC investment, and many people ask me about this on the market, is how do you compare this type of corporate investment, CVC, versus another major type of corporate investment, which is majority acquisition. So for this comparison, I'm plotting Google's majority acquisition CVC in one particular year. In 2021, on the left-hand side, this bar has 4 deals featuring 4 majority acquisitions that Google disclosed on the annual report. So it totally amounts to 2.6 billion, so average 600 million per deal. The thing that looks like a sock on the right-hand side is the CVC investment. In 2021, they made 120 of those deals and only amounts to 1.8 billion. So on average, they're only paying 15 million per deal. So this actually highlights the strategic advantage of using the CVC to interact with the startups, compared with majority acquisition, especially the kind of kill acquisition type. Why is that? Well, if your objective is to get to know your competitors before they grow big, CVC can totally give you this access. And by making a minority investment in those companies, you actually don't need to resort to this very expensive majority acquisition in order to sort of fully own them. By making this minority investment, you got to sit in all the board meeting of the startup. You get access to their proprietary information on the business, on the technologies, and you got to know what they're up to next. So all those things you can just do using a very cheap kind of minority investment in a CVC without having to resort to the very expensive type of majority acquisition. And because of this, actually the antitrust authorities are becoming more and more alerted of this use of CVCs for those antitrust reasons. So this is one article in 2022, end of 2022, that shows that they're sending out those warning letters to CVC managers that warn them they're going to tighten this enforcement of no interlocking directory rule. So a lot of you are practitioners, you know like what this means, right? So you, as a corporate executive, you cannot sit on the board of your potential competitors. This does not only apply to CVC, but also to like other corporate investment as well. This speaks particularly to this important use of the CVCs to sort of sit on the board of the potential competitors. Another set of stylus facts involves how CVC.
I think it's helpful for your paper. Let's go back to the Google Uber investment. Dave Drummond, who was the Google member on the Uber board, had to exit as soon as it became clear that the Waymo division was going to compete. So that was, I think, 2016.
I didn't know about that.
Well,
That's very helpful. I just realized in response to Danny's question, I want to show some of the kind of tools the CVC used to get more control of the startup. So a lot of times, on top of what normally is involved in the VC deal, those CVCs are more likely to obtain more contractual rights. So those include like right of first notice, and right of first refusal. What does right of first notice mean? It means like if a startup receives a bidding offer, they will be the first one to be notified. Right of first refusal is even more aggressive. It would give them the veto power to say no to any of the acquisition bid from outside. That will give them a lot of time and power to deter the other acquisitions by other firms. Yes.
When you were talking about the hypothesis 2 and the reduction in the IPOs, did that account for the fact that the rights of first refusal, meaning they might bring it inside? Did you consider both exit outcomes to be comparable, or did you isolate IPOs versus acquisition?
Well, I study IPO, acquisition, and failure. So there are three different ways they can exit. So both IPO and acquisition are considered successful exit. And then on average, you see that this failure rate goes down, meaning IPO plus acquisition goes up, and the IPO goes up even furthermore. All right, and secondly is what Danny was asking. They don't have board seats, but they take board observer seats. That would alleviate them from this fiduciary duty, and they would give them more flexibility to use that information to benefit the parent company. And last but not least, they sometimes offer those complementary type of resources that the entrepreneurs would find themselves better off fighting suit. So one anecdotal evidence on how the CVC might be used that to hamper the competitiveness of the startup. This is one Wall Street Journal article documenting that Amazon has this kind of track record of investing in the startup and then trying to understand their core technologies and sometimes steal them to use in-house product like Alexa. And later on, the startups having a much bigger competitor would have to be squeezed out of the market and pivot to some other suboptimal areas. Right, so how much time do I have?
We have about 10, 12 minutes.
Okay, perfect. So another set of facts involves like how CVC invests. Early on, somebody asked me, what kind of deals the CVC does. Well, they do all sorts of rounds, as early as angel seed, pre-seed round, as late as Series D, FG. And another prominent feature of CVC is that they tend to pay higher valuation compared with other VC investors. And compared with other VC investors, they're also more likely to be a sole investor of a deal round. Notice both of those features give CVC actually more controls of the startup. Why are they paying higher valuation? First, the startups might be anticipating some of the potential anti-competitive effects, and they're asking them to pay a higher valuation to pay off that concern. And also, they tend to obtain those additional contractual rights, which makes their stakes more expensive. And why do we want to be a single investor of a deal round? Well, that has to be with how you actually invoke those contractual rights. So in order to, for example, exercise right of first notice or right of first refusal, you need the majority voting of all the investors of that particular round. So if they have to do it in the syndicated deal with other VC investors, then they have to persuade all the other investors to be on board with this exercising of the right of first refusal. But if they are the single investor of a deal round, then they have all the power to actually use those contractual rights. Is there a question?
Yeah, I mean that could be also consistent with your selection story, right? Like they're just better thinking, and so the fact that they identify better venture drives up the amount they invest, right?
Yes, that's possible. Yes.
So I want to add another thing to your, so you assume that the only investment is an actual financial investment. But if you are a CVC and you like the company, you might assist them through some kind of license or contract that is akin to a financial investment, and that is therefore driving up the premium.
That's possible. I guess you can talk about, for example, they instead of paying in money, they can do an in-kind investment. For example, Amazon is providing all this computing, cloud computing hours for OpenAI to help them with this computing power.
Exactly, and that you're not going to see merely by looking at the investments that it's difficult to quantify, but this may also be driving better results. Because basically, unlike a VC that only has money, they have other stuff.
It's almost a strategic partnership,
Yeah.
not just a financial partnership.
Yeah, that's precisely kind of the resources and support channel we're talking about. I think it's you're gonna see in a minute. The result says like they play a huge role, especially for those very successful companies. Right. So I'm gonna briefly talk about the IV. I know lot of you guys are not from kind of an academic perspective background, so I'm going to be very short on how I construct the instrumental variable approach. But just know like kind of the idea. What we're doing here is just to capture the actual treatment effects and kind of tease out the selection. So the specific selection issues in the CVC context could be multifold. Cherry picking startups within one industry is one. Having the superior ability to actually predict which industry has a better growth output is another layer of selection. But those all have to be controlled in order to conclude on this treatment effects. So what I did is, again, using this institutional feature of the CVC, that they draw money directly from the parent company's balance sheet. So you can think of a version where you can use the total cash flow to the parent company and use that to shock the CVC's ability to invest. But just using the total cash flow is not enough to solve this endogeneity issue, because a lot of times the CVC might operate in a similar market with the startup, and therefore this total cash flow might also be correlated with the startup investment opportunities. So what I did is I went one step further and used the segment cash flow data, and I picked those segments of the CVC parent companies that are unrelated to the startup. A lot of details about how I construct the IV, which I'm not going to bore you. At the end of the day, I'm trying to create an instrumental variable approach that basically you can think about as you flip a coin. There's a very exogenous event that causes certain CVCs to be more likely to invest in certain startups, and sometimes their ability to invest is kind of reduced, and you see how this exogenous increase and exogenous decrease going to do for the startup outcome. All right, so for the sake of time, I'm going to skip all the details about the instrument variable approach and just directly come to the results. So let me first look at the IPO results. So the left-hand side variable is basically the likelihood of the startup exiting through an IPO, and this dependent variable is basically whether the startup received a particular CVC investment in a particular year. The first column gives us a version of the result without IV, which means we're having both the selection and the fitment in. It's basically you have a thousand firms with CVC investment and larger firms without CVC investment, and you want to just compare the outcome of those two kind of firms. And the effects are the CVC invested startups are having a much higher likelihood of IPO exit, but this could be attributed to both the selection and the fitment. So later we're gonna look at the IV results, which give us only the treatment effects, which is significant and positive, which means that only looking at the causal part of the CVC's impact, they seem to benefit the startups in terms of making them more likely to have an IPO exit. Failure rate, this is measuring how likely the startup's going to go out of business before any successful exit. And it seems like using the IV results, having a CVC investment is going to reduce the likelihood of failure. So now the question is, what is exactly driving the positive effects? Is it just because they're providing funding for the startup, or is it because, like what Danny says, they're actually providing a lot more like resources and support that actually help the startups that other VCs cannot actually substitute? This is interesting because if you think about the policy implications, anyone can provide funding to the startup. You don't actually need the CVCs to be one of those investors. But if the CVCs bring something new and unique to this table that other investors cannot substitute, then we'll appreciate the CVC's impact more. So to differentiate these two channels and include this total current year total funding size as additional control, what this does is we control for the funding channel now. And if there's still any effects, it's going to be attributed to the support channel. What do we find here? Well, once we include this total funding size control, the failure rate result is completely gone, but the IPO result is still there. What this means is that if you think about the startup on the spectrum of quality, on the low end of the spectrum, you have those firms that are actually struggling between life and death, and those are the companies that are actually benefiting more from the funding channel. Whereas for the high end of the spectrum, those are choosing between IPO and acquisition exit. Even you control for the total funding size, you give them equally funding situation. Having the CVC still play a positive role in this situation. And therefore, you can conclude that, especially for those more successful companies, they're benefiting a lot from the CVC bringing on board unique resources and support. Right, so far we've seen an average positive effects, but actually this average effects mask a lot of those important heterogeneities across different type of firms, especially when CVC has more and less controls, less that like we discussed earlier. So next, I'm gonna show you some more results that's gonna help you understand, how the CVC's impact will be different across different type of deals. This one involves the CVC's investment in different stages of the startup. So you can kind of separate the startups in terms of the investment stage, whether they receive the CVC investment in the relatively early stage, angel, pre-seed, seed rounds. Those are the pre-A rounds ones. And you have Series A, Series C, Series B, Series C, and relatively more mature post-seed rounds. So you see that the effects that we saw earlier is actually reversed in this pre-A rounds deal. You have actually higher likelihood of failure and lower likelihood of IPO. What this means is that now you start to see this negative effect of the CVC kicking in, and those effects are concentrated in the relatively more nascent kind of startups. And this is actually speaks to this CVC's heterogeneous control of the startup. If the startup invests raise a round of financing in pre-A rounds, for $1 of investment, you can get a much larger share of this company. And you also have a longer period of influencing the startup. And for those situations, you actually see a more negative anti-competitive effects. But once the CVC saves the company, they're able to sort of induce more conflict of interest. Whereas for later stage deals, they're too late to the party. That's not much they can do in terms of killing startup. For the sake of time, I'm going to skip this because I want to also show you some of the real effects. Why do we want to look at innovation results? Well, this has to do also with the morning panelist discussion. A lot of times, the antitrust authorities, they're basically looking at the price impact of the startup, which I argue is sort of a misinformed approach because they're missing out on a lot of those potential impact of the incumbent firms on the startups, because a lot of the startups, they don't even have a viable products that are able to bring onto the market. But you can still observe relatively more of the input of those product market effects, which is the innovation. And also, this is one of kind of the most systematic evidence you can get on these real effect of the startup in the investment stage, because they still file patents, so you can actually see how much patents they file. And if you think about the CVC's strategic use of those startups in terms of benefiting from the innovation, it's really twofold. On the one hand, they wanted to directly curb those entry threat into their most disruptive, their core product market. But at the same time, as we saw in the Pfizer case, they're also trying to learn from new technologies and new industries they're not currently working in. So it's really different in terms of how overlap and how much entry threat they started bringing to the CVC parent company. So in that regard, categorizing startup innovations in two categories based on how disruptive this particular innovation is and how close they are related to the CVC parent's product market. So I have disruptive type, complementary type, CVC related, and on-CVC related. And we're going to, two binary source is going to give us 4 categories. So again, this is kind of the bi-stage results. And what do we see here? There's, if you see a negative impact, this means that the startups, upon receiving the CVC investment, the subsequently reduces the CVC's, subsequently reduces the innovation output, the patenting of the startup. And if you see a positive impact, it means that the subsequently increases their innovation output. And what we see here is that in the early stage companies, there's one categories where you see the most significant drop in the subsequent innovation output, and those are concentrated in the most disruptive type of innovation directly related to the CVC's product market. Whereas for other categories, we actually don't see such significant drop. Whereas for the late stage, those are the companies, let me remind you, that benefit most from the CVC investment. If you look at the innovation output, most of them are actually reflecting an increased innovation output, meaning the CVC investment is making them more innovative. But those innovation increase is concentrated in the CVC's unrelated market. So this kind of dichotomy is speaking to these two CVC strategic objectives. The first one is in the early stage, you see this reduction in innovation output, and this is related to their kind of the strategic objectives of reducing the strategic entry of those startups that kind of threaten their existing product market. Whereas for the late stage, where you see an increase in this innovation output, this is consistent with these them trying to learn from new industries and new technologies they're not currently working in. So they're encouraging those kind of innovation. All right, so I think I'm right on time. Let me conclude. In this paper, I studied these strategic interactions of the incumbent firm and the startup by looking at this kind of financing channel for CVC investment. I have an instrumental variable approach that helped me tease out the selection in order to rule in the treatment effects. What I find is that on average, there's a positive impact of the CVC investment, but there's also anti-competitive impacts that they're inducing this kind of conflict of interest. And this effect is more prominent when CVC has more controls over the startup. So if there's one particular takeaway from this paper, I know I've talked a lot about the CVC. There's only one thing I want you to remember walking out of this room. It is the CVC's impact is really nuanced. There's no blanket one-size-fits-all policy to just increase or decrease CVC investment. But instead, as entrepreneurs and as antitrust regulators, what we should really be thinking about is how much actual control you gave for the CVC. And that's all I have for today. Thank you so much.
We had some questions during it, so maybe two questions, and then we'll move on to the next one. Is that all right? We're a little over time.
So, fascinating paper. There's a lot to do, and if I love this research. One thought on the results that you show about the startups diverting from the core business, from the CVC related innovation. One thing that probably we didn't cover this morning is kind of like duplication of R&D. So I do wonder to what extent we see instead the firm developing those kind of innovation in-house. In that sense, seeing firms, startups diverting from that part of space could be efficient, right? We're just avoiding duplication of R&D. So just if you have any thoughts, or maybe you can look in just an additional analysis.
Yeah, I guess if you talk about like the social welfare of the overall CVC investment, then you have to take into account both the innovation effects on the startup side, but also the innovation that the CVC parent is doing. So right now, I'm very cautious not to make a conclusion on whether this is welfare destroying or welfare improving. In order to do that, you have to take into account both the innovations on both sides. But in fact, what the literature is showing is that the CVC parent company, they do benefit a lot from this CVC investment by having this knowledge spill over. They improve their in-house R&D. So the actual total impact is different. That's something to study along the line. Yes.
Got something we get. So I want you to think about pairings of CVC with certain venture capitalists, and look particularly if there's some kind of synergy in those pairings, and that might go to certain of those VCs are more likely to have some of their portfolio companies be acquired by, say, a Google, so that if we have a certain,
Yeah, go ahead.
no, it's okay.
Yes.
It has already spurred you to a thought, and your thought is more important than mine.
That's absolutely a very good point, because a lot of times you see those negative impact, and if you assume that other VCs are rational, why would them let the CVC in, knowing that on average there's a negative impact? The reason why you're bringing it up, there might be some correlated conflict of interest. They're trying to maximize their overall exit by having the CVC parent company acquire some of other portfolio companies. It could be totally one of the reasons why they're able to let the CVC in. Yeah, so I agree with you, but I don't have any systematic evidence of that. There will be an interesting lead.
There's some questions to the startup, even in their very early stage, and concerned about CC, like the 3A stage.
Yeah, you see a lot of those phase. So the entrepreneurs, they are aware of some of the conflict of interest by the CVC, especially after this recent Wall Street Journal article is out. But ex ante, it's very hard to fully anticipate what's going to happen with the CVC investment. So I think that's the reason why a lot of those startups still let the CVC in. even though on average doesn't make big impact.
You would want to like Google want to like think on your investment.
Yeah, there's also kind of a certification effect. Having Google as one of the investors sort of help you improve your brand image. Yeah, so that's one of the reasons they do it.
Can you go to the last, the previous slide? Okay, in your second bullet, third sub-bullet, under anti-competitive, CDCs have more control over the startup. Again, with sort of policy implications in mind, I'm wondering if, if this study were to get wide reception, if antitrust enforcers would start thinking about limiting as conditions on a merger, for example, or an acquisition, if they could start thinking about imposing constraints on the amount of control a CEC can have over the startup, which sort of then invokes all sorts of concerns about minority ownership, passive ownership, all this kind of stuff that's highly controversial in the antitrust space. But even in the Google search case, which is, as we know, in the remedy space, the DOJ has now walked back its prohibition on Google investing in AI firms, right? Because that's what I call remedy overreach. That can have widespread effects on trading partners and other companies that interact in the ecosystem. But I'm just wondering if this might have a similar implication for remedies.
Yeah, totally. I'm not sure how much is overreach, but the way I think about it is instead of just having a blanket policy saying you cannot like CVC investment, you cannot invest. What they should be probably paying more attention to is, for example, whether they're investing as a sole investor or investing in the deal syndicate, how much actual minority investment they have in this company, what kind of contractual rights they're obtaining out of this deal. So those are the kind of the important metrics they should look at. I think we are out of time.